maybe by next Sunday. Okay?
Wait,
So just redo the case, looking at my approach. I won't post my solutions because then the redoing is absolutely pointless.
so you're not posting this until next week?
Next week, I wanted to look at what I had in mind. Okay, what I had in mind was an internal Harris project. You're the finance guy, you have a discount rate, which there was some discussion of discount rates. And
I'm not sure whether you're going to go through this now. There was a lot of data.
yeah.
That's, for at least the non-finance guy here, to try and articulate and to withdraw and extract the pertinent data, very confusing.
Yeah.
Are there any suggestions or tools or methods? Or is it just
No. So this is a general thing in life. Yeah?
I mean, I think that's really the approach that we took. We didn't take that, like I said, we looked at it and we said, there's just too much information here. Let's just boil it down to the details.
And as I said, your approach is a valid approach, not what I had in mind, and that's a shortcoming on my part. I wanted you to be inside Harris with some projections. You need to make the projections yourself, Exhibit 7, and then find an NPV. Some missing numbers if you take a judgment call, like terminal value. Okay? Right. What you did is a very valid and important exercise for any corporation, which is checking if my projections make sense, given reasonable assumptions on market share, etc. Okay? So, yeah. Now, your question, there was a lot of data. That's a general thing in life and in cases. There's a lot of information. Okay? What is relevant is the skill. Okay? What do I need to know is the skill. Working out. A lot of opinions, more than data, there are a lot of opinions in meetings, etc. Focusing on the bottom line, distilling, right? So big data is fantastic, but you need a filter, otherwise it's, right? So, okay. So, alright, so it's NPV. So let me just talk about concepts a little bit more and spend a little bit more time than I was planning to on the concepts. Free cash flow. What are free cash flows? When we value a company or a project, free cash flows are the total money being generated, ignoring some of the tax effects of interest payments, etc. We will adjust for them when we talk about weighted average cost of capital in that 20% discount rate. And I wanted you to use, here was a basic principle. We want to record cash flows as and when they happen. Here, if you remember, it is right. So these are the formulas and the stuff you need to use. So here there was a difference between net income and profit as a man on the street to understand it. And the difference was inventories, which is not profit, it's cash, which is an asset, spent to another cash, which is parts, but it's a cash flow, right? And then this entire adjustment for accounts receivable I did here. I was adjusting net income. Depreciation is just a tax thing. I'm adjusting for depreciation, it's not cash. Increase in accounts receivable is not received, right? I talked about, so it's not cash I have in my pocket. The guys, my clients will pay, I know, but it's not cash in my pocket. Increase in inventories is cash spent, increase in accounts payable not spent. These are the change in net working capital stuff. There was some accrual in my original example. Taxes payable, I adjusted that back, but since we're going to work with annual data for these evaluations, that's going to be provision for taxes, which is treated as cash paid. Okay, and this financing flows I want to ignore. Our ambition is to put all the financial effects in one number, which is the 20% discount rate. Okay, this is not what I've covered, but I thought you did NPV in your basic class. Okay, so it doesn't really matter. It will turn out that the assumption in my hint sheet that they use retained cash to finance the project, it does not matter if we have found the correct discount rate and we'll do this later. Okay, then free cash flows. Terminal value is this long-term value, and I talked about some growth or using multiples, especially enterprise value multiples, and we'll be using that too. Okay, so these two sections, reading them, okay, is what should go into the NPV analysis. Okay, the CAPM and the cost of capital section, which I haven't covered yet, are when we, in the second case, we try to estimate discount rate, which is finance, to put it crudely. Okay. Okay. So we want to come up with the objective of an estimate the project's free cash flows. These were the information there was given, and the 11% inflation scenario in Exhibit 7. in the 0% inflation scenario in Exhibit 6, I believe. You have to come up with these adjustments. They are on my slide 25, the adjustments, the formulas for all the adjustments. Guiding principle of adjustments, as I just said, is to include only the cash items. So add back depreciation because it's an accounting tax item. Adjust for non-cash net working capital because accounts receivable is not cash received. Accounts payable is not cash paid. So that's why I'm adjusting for the changes in net working capital because they are non-cash items. Very close to cash, they are in current assets or current liabilities. And for capital expenditure, it doesn't matter if the capital expenditure is financed with a bank loan. Okay, that's the bank loan part is a financial obligation. I'm going to treat the cost as if it came out of my pocket. Okay, and then we have to find, this is the second part of this case. We're going to come back to this case and go into the discount rate. Okay, all right. So here I agree with the first team. Using the data in Exhibit 7, information in the hint sheet, estimated unlevered cash flow. So I ask you to ignore a tax credit, and I think I mentioned in class that any tax loss carry forwards, ignore it. Assume that the rest of Harris, which I know from the case is very profitable, I absorb it, right? So that's what I'm doing. So I had an earnings before interest and taxes in row something of Exhibit 7 for the first till 1986. I think I gave you a tax rate. This is unlevered net income. I added back depreciation, and this is unlevered cash flows from operations.
How do you get depreciated in the first year if there's no taxes?
I'm sorry? What is what?
How do you get depreciated in the first year? In 1981.
There was a number in the balance sheet numbers in Exhibit 7 on depreciation, 833.
How is that if you don't have taxes?
Who said I don't have taxes? Because I'm assuming that the taxes are the rest of Harris. It's taxed at the aggregate level. The case says so. For tax purposes, it's going to be aggregated. It's going to file taxes for Harris, not for the plant separately. Okay? For tax purposes, it's so the tax losses. I don't carry them forward. It's not a standalone from tax perspective. I'm assuming Harris has enough taxable income to absorb the tax losses.
The previous.
Okay, so I add them up, and that's unlevered cash flows from operations. Okay, so what are the two other things? Net working capital and non-cash net working capital. Also provided in Exhibit 7, and capital expenditure. Now, capital expenditure is one of the unusual parts from the standard textbook examples you do. Okay, so I got it from the balance sheet. This is the definition of it. If you see in year 1980 or 81, a balance sheet total book value of long-term assets, not short-term. Short-term assets are in the net working capital adjustment, right? Book value T, it's last year's book value minus the depreciation in year T, because it's always reported net of that year's depreciation, plus any new asset acquisition, right? That's the definition of how over time the balance sheet works, from which I can figure out capex in every year. Okay, I can just rework that to find out capex in every year. So I threw in all long-term assets together with the project plant and equipment. That's my total stuff. That was the total every year. These are from Exhibit 7 again. This was a one exhibit case. So all that plethora of data as far as the cash flows estimation is concerned, terminal value, I wanted you to focus on Exhibit 7, so I was not clear on it, perhaps.
Well,
Their pro forma forecast. It's an internal.
We couldn't figure it out.
Huh?
We couldn't figure it out.
Okay, so the pro forma projections, okay? Then I add back depreciation. These are the capex numbers. These are the differences, right? This minus that, as I said. That's the previous formula. I'm using this previous formula. Book value T minus 1 plus depreciation T. So for example, in 1981, I'm looking at book value T minus book value T minus 1 plus depreciation. Okay, you must have seen this in maybe accounting course or something like it. So that's what I did. So this is capex, and it's significant capex throughout the project's life, which was actually the case. Didn't provide me with information. There was some talk of building up to capacity till full capacity might be hit in around 1984 or something like that. So those were the numbers I got. Okay. All right. Net working capital is current assets minus current liabilities. Anything which you do within the year, current assets include cash, inventory, receivables, and other current assets. Current liabilities, there was a number, it is 9% of sales, so the standard sales constant forecasting model. On page 5 of the page. So those are current liabilities. We were given sales number in Exhibit 7. Okay. So we need to find net working capital every year and the
It's
change.
5% of sales each year. So
Each year.
5% of revenue,
Sales for that year, sales revenue for that year.
right? I mean,
9%.
Yeah.
Page 5 and 9.
Yeah.
Yeah. Okay. So that's what I did. Accounts receivable, inventory, other, etc. Non-cash current assets. I want to do non-cash net working capital for a principle I talked about. We're doing the principle is exactly that we're adjusting for if any money is a current asset, accounts receivable, we have not received, right? I'm going to subtract that because that's not cash received. Anything I'm supposed to pay but not have paid yet, I'm going to add that. That's non-cash. Okay? It doesn't make really a big difference. Very often you don't have cash information when you're doing this for a real company. So you just assume implicitly that the cash position is not changing. The change in non-cash net working capital is the same in change in cash net working capital. Okay? So here I found them, the levels, the difference. This year minus that year, so this is 0 to that, incremental. This year minus that year, this year minus that year. Every year minus the previous year is the change in non-working capital. I'm going to subtract that. Yeah, I'm going to subtract that. These are all the ingredients of the formula on yeah, this is the key formula slide. If you just want to get it down to what you need to estimate, free cash flows, okay? So this is the first thing, Exhibit 7. This was the thing I just calculated. This is from the balance sheets over time, pro forma balance sheets. So, yes. Slide 25. Okay, these are the numbers we are discounting. All right, at 20% discount rate. And the principle behind that was the hacker example, where I built it up from scratch. An example where my only guiding principle was my two guiding principles. One was that I would ignore any finance inflows, even though I'm overestimating my tax bill. As a result of this, I'm going to somehow throw it into the discount rate. You have to take that on face value right now. The next topic I'll talk about first one, then we'll do it in detail in slides 2. And the other is that I'm going to adjust any cash received, but any profits received, income received, but not in cash. I'm going to subtract that. Any cost paid, but not in cash, I'm going to add that. Anything changing cash to something else, inventories, I'm going to subtract that. Okay? That's the one guiding principle. That goes into this. CapEx might be financed by my bank, but it doesn't matter. Okay, because that's a financing flow from the bank. Free cash flows is the stuff that will be sold to the different claim holders, including shareholders as well as my creditors, my lenders. Okay. So that's the guiding principle. Okay, so so that's slide. So unlevered cash flow from operation in slide 68, capital expenditures in slide 66. I mean, capital expenditures in slide 68, changes in normal etc. Slide 70. I subtract these two from that, so I get these are my overall free cash flows years 80 to 86. Okay, and they look pretty bad. The project doesn't pay back.
Our project was so much better.
Yeah. So it doesn't even pay back in the first
3 years.
till 1986. Okay, so clearly at any cost of capital, at any discount rate, it's a negative NPV project unless we're missing anything. What can we be missing? Long run value. Okay. So
Terminal value that was.
terminal value. Okay. Like very often in cases in business projects, it's the long run which is going to make us or break us.
So what's usually, how long do you look at and say like this may be profitable?
It varies. It's something like under 10 years.
10 years.
Okay. Explicitly depending on the applications we have in mind, you typically cannot have any reliability between 5 to 10 years. Typically, if you think of private equity as an example, there's an explicit horizon of 5 to 10 years. There's an exit decision imposed, but at the end of 10 years we'll be out of it. Okay? So, okay. So here is a number of ways. All of you thought about some of these ways. Estimate the future growth rate of cash flows. Directly estimate the market value of the project using case information and asset values. I'm going to do that because there's a lot of information based on accounting numbers. So whatever they mean, let's try and use them. Maybe the book value is not the same as market value, especially if there's growth. Okay? But at least it's some kind of number in the ballpark, so I'm going to use that. And then I'm going to use comparables and multiples. Okay? So here is my free cash flows. Once again, the free cash flow bottom line. So my first is trying to find a growth, staring at it and trying to find a growth. There is, okay, it's negative. The project has a lot of capital expenditure, and that's why free cash flows are negative. 1984 looks like the turnaround point. If I lose the last 2 years of growth, 11 and 12, I get numbers like that, 11 and 12. Okay? Does that make sense? Now here is some subjective information in the case, or it's actually quantitative information. The case does say,
Any pro forma questions on a little case like this, we should always look and analyze at the outset.
NPV.
Because you said what you had in mind, we didn't end up doing.
Yeah, so maybe my case hint sheets didn't say that you're working inside Harris. So you're using Harris's pro forma numbers. You did a different exercise, which you looking at comparables, making some market share assumptions. You need to check those numbers with the pro forma numbers.
We felt we had to justify why we were reaching our numbers by looking at the market.
By looking at the comparables. So
Right.
if that was not clear, then it's a shortcoming on my part. So now it's clear, so that's why I wanted
Because Professor, it doesn't make sense if you enter a new market, right? To look at how you were doing first.
So that-
you never went in there yet. Doesn't
Yeah,
make
but the
sense.
guys, there's a pro forma statement provided in the case, which are the guys who are in the shrimp business. So all the analysis they have done,
Okay, we have
presumably
taken
they have taken into account reasonable assumptions on market share and come up with those pro forma projections. Now you were doing an independent verification of those given the information you had. Okay? What I wanted you to do was just to do the NPV calculation. Okay? How to apply an NPV in class, in the first finance course, the set of numbers you get, something like profits, you discount it, that's undiscounted. Now I want to get into the real business of it. Our main focus in a finance course is actually the discount rate. Okay? This is the border of accounting and finance. Okay, we're going from accounting to finance. Okay, we're going from net income to cash flows. Okay, so that's what I wanted to do. Okay, there's 11 to 12%. Does that suggest something? The case says that the plant will reach full capacity, start to reach full capacity at 1984, and it will hit full capacity in 1986. How can things grow after it hits full capacity? Expected sales are, well, it can grow in prices. Quantities of processed whatever they were making, breaded shrimp is constant, but prices could grow. Alright? And what's the inflation scenario? 11%. So that makes sense actually. So whoever wrote up that number, these numbers, there's a 11% or thereabouts close to inflation. So it's going to grow at the rate of inflation. Okay, in real terms it's not growing at all. Okay, this is the post 70s oil crisis, inflation was high, things changed. Okay, here, I have this line. On page 4 we're told that the project's full capacity is 15 million pounds. From Exhibit 7, 1986 is the first year the project operates at full capacity. What creates growth given full capacity? I'll repeat myself. So the 11 and 12% number makes sense, which I got by inspecting my free cash flows. Just from these numbers, I estimated a growth rate, and it makes sense given the other information. Okay, that's all. So then I get a terminal value of 29,575. This is in year 1986. Okay, growth 11% assumption. Okay, so that's 4576, whatever it is. So I discounted, it is negative 2 million. Okay, even with the terminal. So based on the growth assumption, it looks like a bad project. Okay? Okay, you don't have to do all the stuff I'm going to do going forward. I want you to think about the multiples approach I'm going to show you, which is just like what we did in the terminal value section 1012. Right, so here I want to do something else because I also want to use this information. So here I just say, okay, forget about this finance business. Just look at what the pro forma, what this projection say about book value of assets, accounting numbers. What are the accounting numbers? Okay, so I add up all the information on Exhibit 7, okay, to find an estimate of book value of assets in 1986. Okay, the details, you can do the calculations yourself. So if I do that, long-term assets, short-term assets, including cash, short-term liabilities, payables. Okay, so I add long-term assets, I add short-term assets on the left-hand side, I subtract short-term liabilities. That's my net value. So what is the idea here? The idea is that if I sell the firm in 1986, okay, accounting numbers will represent market values, okay, which is normally not the case if the project has potential, okay, growth potential. But let's make that assumption that this is the net cash I'm going to get. I'm going to sell my long-term assets at their balance sheet values. The short-term assets, cash, inventory, receivables, I'm going to get their balance sheet values, and the short-term liabilities have to pay up, payables. Okay. So normally market value exceeds book value, so maybe this provides a lower bound on what the terminal value would be, just using accounting numbers. Okay, so I did that. Okay, and I got a terminal value of 32,192, which is based on book values. Okay, so now this is book values. If the project is good, market value should be higher, but this number is higher than the NPV, the growth-based estimate we found, which is supported by the capacity number. So I'm skeptical of that number a little bit for that reason. Okay, and any day NPV is still negative. Okay, you don't really do this. I'm just saying there's something else you could do. You could go by all the information provided in Exhibit 7. Now, this is what I want you to think about: comparables and multiples. Okay, this is the most common way of valuing projects and houses and apartments. Just calm down. So, but here it's a little different. It's not square foot. It's different cash flow from operation multiples. So I had these two comparables: number of shares, treasury isle was given. This one was just a little bit of arithmetic. I had earnings per share. Okay, I had total earnings. I can figure out number of shares. Dividends per share and total dividends. I could figure out total number of shares from that as well. The two numbers were not identical. Okay, but they were close enough. Maybe there was some buyback or something. Okay, these numbers are closing. It's not even clear what the closing price. When? Average over the year, December 31, what the comparables were.
So how do you use the number of shares by housing, by real estate, like to analyze housing?
House they would not use. It's not even a publicly traded company.
Yeah, that's
A house is a house. A square foot, market price. Square foot is the most. Stahl would be able to tell us. What's the most important determinant? Number of bathrooms or something, and square foot or something like that of estimated prices of houses.
It's the square feet, but it's because it determines on how much you're gonna, that's how much you get for the, so it's the size.
That's
I
right.
guess, but it's also location.
Location. In fact,
Some
you say that 3 times. I know.
Some people come
Yeah.
and they're like, what's going on? Only in New York City. Like, I had a friend staying over from California. So I said to her, you know, and I have like a 300 square feet apartment. So she's, yes, how much does it go for? I said 25. She's like, you know, your whole apartment is not even the size of my kitchen, and I pay for a 4-bedroom,
Yeah.
$2,000. And listen, you know, it's all
You go
about
out and
it's different markets.
yeah.
You know,
take her out for sushi, and then she'll know why you paid that. So, I'm going to do a number of. So the debt information was provided. It's not clear whether there is book value or market value. What can we do? The information that is given. We should look for market value. Okay. always. But debt is relatively harmless if the companies are in good shape, more or less, to our recently issued debt. We didn't have information. We had revenues, EBITDA, operating income. I add all interest-paying debt. Some people treat cash as negative debt because cash means interest earnings, which is a negative. We pay taxes on that. I'm not going to do that in this course at least. So here's what I did. I compared equity, debt, total value, book value. This is exhibits 4 and 5. All the information is there.
Yeah.
Revenue multiple. So this is the revenue on the previous slide for each given. Most recent year.
In the slide it wasn't book value. Was there a calculation to get to the book value?
Which what?
Book value. The previous slide.
This one?
No, previous.
This one I did a book value estimate of asset value. I did not use comparables. I used the predictions that in 1986, according to the pro forma forecasts, the book value of assets, long plus short term, less liabilities, is 32,192. I was using that as an estimate. If you sell the plant in 1986, assets are what you're going to receive, liabilities are what you're going to pay out, net proceeds will be this, that's the price you would pay. But this assumes that accounting numbers are the same as market numbers, which may not be the case. But it's another quick and dirty. Okay. Now what I did was I had this for the comparables, 1979. Okay. Generally, I talked about comparables. There are assumptions there, right? I'm using comparables today to find the value in 5 years, and that's assuming that the market is not going to change dramatically. So you might want to use the most recent number as
But
opposed
let me ask
to
you a
long
question.
history.
Well,
That's what I did. I know that's what I
were,
did. Yeah.
most of the companies were private, so it was hard to use comparables. Not only that, the risks were, like the risk, the uncertainty, were like a few factors, like they said that like when it rained and then the size of this. How do you predict half of these things? So you don't know the size of trip you're gonna get.
That's why you're using publicly traded companies and market values. You're relying on the market.
But
There were two
no, but
public.
you can rely on the market. Because they're telling you, there are 2 public ones, but that's not the point, but they're telling you that in every year, it fluctuated, it changed according
Right.
to, and what happens if there's like.
The market knows that.
No, the market can't predict natural disasters. So how do you know if something or oil spills? So, I mean.
Did you read the Oscar predictions link I sent you guys? The market knows stuff. It's pretty good at predicting stuff.
It's pretty good.
Yeah.
Natural disasters too.
Better than, so this is Oscars. I sent you an article on Oscars, so which is tonight, right? Yeah. Oh my
Are you watching it?
So the one
Unlikely.
Yeah, I don't know.
Only the imitation game. Only the imitation game. Is it up for the Oscars this year? No. Then I'm not watching it. I like Alan too.
Oh yeah, I didn't get to the article you said about that.
Yeah, so it's about prediction markets. Prediction markets.
Markets go up.
No. There are specific markets. There's a presidential election come up. I can tell you last year just by reading, being aware, I'm a politics junkie. So I made 30% return in one month. I called Indiana for Obama, this is 2008, which is a heroic bet. So you know how these guys work? So you bet whether Obama is going to win. Buy Obama or you sell McCain in that year.
Where do you do this?
Intrade.com. Intrade.com, there are many websites. Intrade.com is one of them.
So it's like gambling.
It is gambling.
What is the difference between what is wrong with gambling?
Nothing.
Yeah.
No, but it is. It's
It's-
just not doing like poker.
It's risk management.
It's cool.
Yeah, look.
Cool.
Yeah,
USD?
Wait, so what happened?
Oscillators.
USD. Yeah. You might need I think I needed a Canadian credit card.
Are you kidding? Really?
Yeah. It may not be legal in America and all, but there's some legal. Yeah, but EU, it's fine as long as
Easy
you.
turn account.
Yeah. So, right. So these are things you can buy Obama. You can buy pretty much anything. Just go to intrade.com. Check out the list of markets. Nobel Prize economists. You can bet.
Can we make a living out of this?
The market doesn't have sufficient debt, but you can potentially.
Well, you're still teaching us, so I guess.
So,
it's not
right.
a
It's
secret.
right. It's not about money. No,
No.
it's about sabbaticals. So you buy Obama at some price, okay? If Obama wins, you get $10 per contract, okay? If Obama loses, you lose your money, all right? So the
Can you
price
just
would
look at
be
investment?
$698.
But you have to be a member.
The price would be $698 a contract. That's it. That means that the market thinks that Obama has a 69.8% chance of winning. This is our learning. Clinton and the markets at this point, Hillary, that actually will win the Democratic nomination is in the 70s or 80s, okay, which is the highest in recent memory. So market
Doesn't make
thinks.
sense.
So anyway,